Kitco Mining's special coverage of the Precious Metal Summit is brought to you by Nucor Gold.
Fix the money, fix the world is Lawrence Lepard's motto. Lawrence is an investment manager at Equity Management Associates. Lawrence, welcome back to Kitco.
Very nice to be back with you.
Lawrence, what's been keeping gold companies down? I mean, I'm looking at the gold company index, the GDX, down 3% for the year. You're looking at the tech index up nearly a third over the same period of time. Gold prices are still pretty good. They've been in the 1900 range for the last couple of months.
Yeah. It's a really interesting phenomenon. And I get this question from my investors every day, right?
Mm-hmm.
Why aren't we making money? And we'll talk about why I think the gold price is holding together, but let's talk about why the companies are performing poorly relative to the price. I think it's really a combination of future expectations about the gold price. So if you go on Bloomberg and you Google, you look through and you say, what is the 5-year out projected gold price, mass of the analysts in the world? And they come up with $1,700, okay? And we're at 1920, say, or 30, whatever we are today. And then you look at what's going on with inflation, and we know, for example, that ASICs are going up at 8 to 12% a year, fairly consistently. I mean, ASICs used to be in the 900 to 1,000 range, and they're now pretty clearly in the 1,100, 1,200, sometimes 1,300 range.
Sorry, I'm going to cut in there for a back. ASIC meaning?
All-in sustaining cost to mine an ounce, right? Which most, I'm sure your listeners know. Yeah. And so, if you're thinking that in the future we're going to have continued inflation in that ASIC, it's going to keep creeping up to 13, 14, 15, and the gold price isn't going to go up, it's going to 17. Guess what? Your profit's just disappearing. And so as a result, they sell the stocks down and the margins, as the margins decrease. Now, my strong opinion is that there's no way gold is going to be $1,700 in 5 years. I think gold is going to be between $3,000 and $10,000 in 5 years. And yes, your ASICs will go up because it is becoming clear to me that we live in an inflationary world. And that, while they've tried to tamp it down, they haven't been completely successful. And that's particularly notable as we now look at what's going on with oil. And some of the tamping down of inflation was done through manipulation. I mean, draining this strategic petroleum reserve was just blatant market manipulation to get the oil price down to help Biden win the election and make inflation look lower. So, and you can only do that once, right? So it's an unfortunate set of circumstances where I think the world hasn't woken up to where the price of gold is going, and the world at the same time sees the cost of mining an ounce increasing steadily, and they conclude, rightly so, that if those two things continue, the gold price doesn't go up and the costs keep going up, the margins are going to decrease, and so they think this is a shitty business. And it's not a shitty business; it's a good business, but if you put in the wrong assumptions, you can make it look like a shitty business. And so, as a result, the GDXJ. I mean, frankly, the GDXJ and the GDX, in my opinion, have never been so cheap. I mean, this reminds me very much of 2015, or 2016, or 2018, and if you look at, there's a chart on bullish percentage of gold miners, it's down to like 15%. I mean, this is the point. I mean, I'm actually very excited about where we are right now in the market because it can't get any worse. And if it can't get any worse, what's it going to do? It's going to get better. I mean, by definition, right? So I'm pretty excited about it. I mean, I think, and I'll follow that up with just, let's talk about the gold price because that obviously drives all of this. I think the most important thing that a lot of people have missed, and to me it's a really incredibly big signal, is that here we are, we have the Federal Reserve has shoved the cost of money up 500 plus basis points in the last 2.5 years or 2 years. And yet the price of gold is within spitting distance of an all-time high. I mean, in the past, in old macro land, if that had happened, gold would have gotten hammered. And it hasn't, and that's a tell. And what that tells you is that gold is looking around the corner, recognizes that what they're doing is unsustainable, recognizes that there's going to have to be a pivot and a change of course because mathematically the Fed is trapped. And they can lie and they can gaslight us and they can spin the numbers, they can do all the stuff they do, but the math is unrelenting. It's just unrelenting. And we saw it, and the math keeps popping its head up. I mean, in March, when Silicon Valley Bank failed, the math popped its head up. You got a real problem here. You got all these mismatched duration long assets and all the banks are underwater. And black letter law, Dodd-Frank, we will never bail out the banks again. Well, what did they do? They bailed out the banks again. They broke black letter. And what this tells you, and what it tells me, is that these people are complete liars and they're working to maintain their system because it benefits them and it makes them rich. and they will lie right up until the point at which they cannot anymore. And so, in my opinion, there will be something that will break. We don't know what it is, but something that will break, and it's probably within the next three to 18 months at the longest. And at that point in time, they will have to reverse these policies. Money supply will have to start growing again. Inflation will come back with a vengeance, and gold will go through the triple top of $2,100. And, we'll be off to a $3,000 gold price and $35 or $40 silver price. And, I've just been meeting with mining companies all day long. I can tell you that if we have those kind of numbers in the metals, these companies are all going up, not 100%. They're going up 200, 300, 400%. I mean, it's insane how cheap they are. So, it's a matter of, in my view, it's a matter of just hanging on if you're an investor in this space. I mean, I've had some investors who panicked and they want out. And, honestly, I mean, to me, that's a bottom indicator, because they were actually the same investors who came charging in 2020 after I'd had a year where I was up 122%. So, and the year before that I was up 97%. So, but to be fair, I mean, I brag about those numbers. I'll tell you, since then I'm down 50%, right? So, I mean, this is a very much a roller coaster like business, and particularly given the way the Fed and the others who are running the system behave. I mean, I've said this many times. I feel like, they're driving a clown car on an icy road, and the two guardrails are inflation and deflation, and they keep crashing off both the rails. I mean, they were printing like crazy when we knew we had inflation, and now they've slammed on the brakes, and they've, got the money supply to come down, and things will become very, very deflationary very, very quickly, and the outcome of that, of course, will be a break in the system, like what we had in March with Silicon Valley Bank, or like what we had with the repo blowout back in 2019, or like what we had in 2008, or and with every one of these, they have to go back to the printing press, and they will. I know that was a long-winded answer, but I figure I'll give you the complete view.
Let's just stick with miners for a second as well too. We're at the Precious Metal Summit here as well too. How are you applying this thesis though? With you have the idea that gold is going to be going to the 3,500 to between 10,000 right now. There's a lot of ways you can play it. Absolutely. So we're at the Precious Metal Summit, and then you have the juniors, you have the producers, you have the streaming and royalty companies. You even be able to hold it physically as well too.
It's a great question. It's a great question. I think it for every person it's individually different. And this is not investment advice. Everyone should make their own, look at their situation. The safest and lowest risk thing for people to do is to buy physical metal and hold it themselves, right? And the reason for that is there's no counterparty risk. And I know with great certainty, or I believe with great certainty, that the underlying value of these metals is going to increase substantially in the next 5 to 10 years as we're in an inflationary environment. So that's the starting point. And anyone who's looking to get into this area, I say start by owning the metals, okay? The problem with the metals, or not the problem, the issue with the metals is they don't reproduce. I mean, they're geese that don't lay eggs. They just sit there. And so, there's no alpha outside of the monetary debasement. So then you start to say to yourself, okay, what if I could find a company that produced these metals and had a stream of revenues or stream of dividends coming in? And that's where we, of course, get into the miners. And there are a lot of different ways to play it. The royalty companies are one of the safer ways to play it. Because of the model where they're not as exposed to the capex and the up and downs, and they generally are very diversified across a bunch of streams. The issue is that the market knows that the royalty companies are the lowest risk, and therefore they're quite expensive as a multiple of cash flow. And so, I put my mother in the royalty companies. My fund doesn't personally hold the royalty companies because I'm looking for more alpha than a royalty company has. So then now you're in the bucket of, okay, I want a company that's in the gold mining business or silver mining business in some way, shape, or form. And there are 3 very broad categories, right? There are drill stories, there are developers, and there are producers. So let's go from the safest to the least safe, okay? The producer is the safest. If you've got a mine, it's operating, it's throwing off cash, it doesn't need to go to the market to raise money. That's a safer bet than something that needs to continually come back to the market and sell stock and raise money. So a big piece of my fund is what I call producers. And I view the best portion of the producer universe as what I call the growing producers. And because in the growing producers, you have 3 ways to make money. One, right now they're trading at very low multiples to cash flow. I have some companies that are trading at 2, 3, 4, 5 times cash flow. That's low, okay? 2, they are very levered to the price of the metal. So, while their ASICs are climbing over time, if the metal goes up a lot, their margins are going to expand a great deal, okay? And then 3, If you find a good emerging producer, they're increasing their production over time. They may have one mine, but they've got a second mine they're building and a third mine to follow that. And so a 100,000 ounce producer can become a 400,000 ounce producer over a period of years. So all other things being equal, you've got 4x the profit when it grows. So you want to get low PE multiple or low cash flow multiple. You want to get growth in underlying production. Okay, and then you want to look at the overall quality of the company and the deposit. The mine life, the management team, all the other issues that go into is this really a good situation? What can go wrong? But the producers, the best thing about the producers is unless the price of gold falls substantially, their odds of or they mess up their mine, and plus some of them do for sure. But generally speaking, if you're in the quality producers, their odds of failure are quite low. They're not going to go out of business. Okay. Of course, particularly the biggest producers, they're also having a hard time reproducing. They mine gold every year. They have to go find what they mined. And if you look at actually like the production curve of a Barrick or a Newmont, they're having a very hard time maintaining their production level because they mine so much. It's hard to replace what they mine. The smaller companies, they have less difficulty replacing what they mine, and it's because you can find 100,000 ounce mines out there. It's hard to find 500,000 or 1,000,000 ounce mines that the Barricks of the world need. So once you move from the producers, you then move into the two other buckets, and one is the drill story, which is very risky. Then they're both kind of equally risky with different sorts of risk. One is the drill story where you've got a good team and you've got good land, and you believe that the resource that they have is quite small, but that they can effectively drill the resource and prove, to a 43-101 standard, the resource will get quite large. And that's, now you're kind of playing management team and geology. And, there's a lot of risk there, but you're all, and the biggest risk is they continually need capital, and they're going to dilute you. So, they do not have any cash flow. They have no revenue. So this is a burning match, right? And so, they need to find gold quickly with the money that they raise, or else they won't be able to raise any more money and they will go bankrupt. So, so that's the downside. The upside is if it turns out that you have a company, and some of these companies have, market caps of 10, 20, 30 million. I mean, I'm in one called Lavras that had a $10 million market cap. They just had a big drill hole and it's gone up 5x. So, you can very rapidly multiply your money when it does work, but that's rare. They don't all work. A lot of them don't work. So, I have some drill stories, but that's not my major focus either. I mean, my biggest focus is producers. I sprinkle in some exciting drill stories when I can find high quality ones. And then my secondary focus is what I call the development stories. And these are the companies, and we've all talked about all of the Sand curve. So the Sand curve is, you find something and it gets quite valuable. Okay, fine. Now there's some gold there or some silver there. Fine. How are you going to turn that into cash? Yeah. And that's a tricky issue. It takes a lot of time, a lot of things you got to do. You've got to get a social license, you got to get a permit, you've got to get the met work done, et cetera, et cetera. But, over time, and it's what we call de-risking, obviously, over time you can see good teams are able to do that. And sometimes you can see very, very high quality projects that just because of bad market conditions have really gotten sold down. And you think to yourself, gee, these guys in a year and a half, these guys are going to be pouring gold. And when they do, that's going to generate revenue of X and profit of Y. And, if this has profit of Y, the stock is going to be 4 times higher than it is today. So, if my threshold kind of for development stories, it's kind of got to be a 5-bagger. If it's going to work, it's got to be a 5-bagger because they're not all going to work. So I got to, the 5-bagger, give me, in say 2 or 3 years, give me 30% say rate of return. But, and get a couple of those, maybe one of them becomes a 10-bagger, but probably I'll get it wrong a couple of times and they'll become 0-baggers or I'll lose my money. So I got to balance that against the ones that work. So that's kind of how I approach it. And, to me, it's just a probability weighted business. But there are a lot of inputs that go into those probabilities. And I'm watching, that's why I'm here at this show. I've got a full schedule. I'm taking every single meeting I can, and I'm watching and I'm just rating every one of these things on how good is the deposit? How long is the mine life? How good is the grade? How much do we understand the geology? How good is this management team? Have they done it before? Does the market understand it? What country are they in? Is there political risk? Is there permitting risk? I mean, the list is long, right? And you're just taking all of those things and trying to weigh them and try to condense them together and say, okay, that's fine. Looks pretty good. Okay, what do I have to pay for that? If it looks highly certain, may not be that cheap. They may all and so what you're trying to look for is, okay, this is pretty highly certain, but it's not really well understood by the market, and it's pretty cheap. Okay, that's an outsized return. We should go chase that. Do you see what I'm saying? And there's some that are highly certain that I'll buy because they're just such high quality situations and they'll work. But the highly certain ones are usually priced in a way that they're not going to give me my 5x. They might give me 2 or 3x. And when I say these X's, I'm talking about absent a crazy bull market. And I think there's a possibility that we're on the cusp of entering a crazy bull market. And if we enter a crazy bull market, they're all going to go up, okay? Even the junky ones are going to, in fact, the junky ones might go up more, but you want to make, but you got to know which ones they are because you got to get out because they're not going to last. And we've seen, I've watched, I've been through, I started full-time in this. Before this, I was in the venture capital business, but I started full-time in this segment in 2008. And so I saw 2016 where they went up 200% and then they went down, 50%. I mean, I've seen a lot, and it's feast or famine. They tend to rip like crazy, and then they tend to come back and correct pretty hard too. And so you need. It's an area where an active manager who knows what he's doing, or he or she is doing, and watches the data and watches all the inputs very carefully, can outperform because you can say, hey, okay, I might have a 5-bagger. Gee, now the risk reward, it's not going to be a 5-bagger from there. I should sell it. I can go buy this other thing that could be a 5-bagger. And so you need to be, in my opinion, you need to be moving around. I mean,
well, going back, you've been taking all of these meetings today, and thank you very much because you've had a very busy day. How are you saying, do they have a quality management team? And that kind of seems to be like the number one thing when you're talking about people, but how are you assessing that with all the people?
Well, it's just tough. I mean, it's human interaction. It's looking at what their history is. It's asking them questions. It's looking them in the eye. I mean, and I get fooled. I mean, we all do. But over time, I mean, I'm 66, right? I mean, and before this, I was a venture capitalist in the tech space, and so my entire career has been evaluating whether or not somebody's telling me the truth. I mean, that's been a piece of my career, and so I just kind of tend to have a Socratic method of asking questions until I get people to kind of, spit out the truth, or I realize they're not spitting out the truth, in which case it's kind of like, and I mean, yeah, there are people and companies that are just completely unbackable, even though in a lot of metrics they look pretty good. I'm just like, no, I just don't believe it. I'm not there. So, but the nice thing about a bear market like this, and the nice thing about having been in this industry quite a while, and when there was a lot of that was in 2011 when things were just nuts. Okay, remember the top of 2011? I mean, everybody and their brother, you're changing your name to Silver Company, et cetera, et cetera. It's been a pretty tough market since 2011. 2013 was 11, 12, 13 were a disaster. 14 and 15 were a disaster. We've come out of it a little bit. 16 was nice. We gave most of that back. We had 2 good years. 19 and 20. Okay, now we're right back in the shitter again, and so we're still. I think we still have kind of what I call battered gold stock bull syndrome, which is people still don't love these stocks, and people are really afraid of these stocks, and managers are actually pretty conservative. And we've kind of gotten down, if you're a manager in this space right now, and you've been at it for a while, you've been tested. You know what I mean? And if you're still banging away and you still believe, the odds are pretty good that you're real. So I have to say, I mean, most of the things I saw here today, they're going to work. I mean, I saw a couple of things I didn't like, only a few. And a couple of them I was just like blown away, like, oh my God, I can't believe this opportunity exists. We got to buy more of this. So,
Lawrence, just one more question that I want to stick with mining. You seem to be playing in first-year jurisdictions as well as playing overseas as well too. What type of metric do you put on, or what type of risk premium do you put on, depending on somebody's far-flung?
Well, no, there's no doubt. I mean, there's a much greater test in my book for companies that are in risky jurisdictions. I mean, there's got to be more upside. And it's funny. I mean, as Rick Rule says, all jurisdictions are risky because all governments are greedy. And I mean, Canada and the U.S. I mean, I don't know if you saw it. I was told today, I didn't see it, that Biden was talking about maybe putting NSRs on U.S. gold mines. I don't know if that's true, but governments are always going to come after these things. Having said that, I'm pretty sure that Canadian, U.S., and Australian companies will trade at a premium in the next bull market, versus South American or Asian or African companies. But within those countries, I mean, you can kind of sort through it all. I mean, Peru took a step in the wrong direction, but I hear today, appears to be coming back in the right direction. There are concerns about Mexico. Ammo's going to be out, and I heard some good things about, I think is it Gomez or this woman who might be a contender for the next presidency there. There are places in Africa. I mean, you have to pick your spots. I mean, there are countries they won't touch, but there aren't that many of them. And I would say in general, it's got to be 50% sweeter if it's not in a safe jurisdiction. Because I think that unsafe jurisdictions will never trade as well, because there's a certain piece of the gold mining public that knows the jurisdiction has risk, and therefore you're not going to get a multiple for an African producer that you would get for a North American producer. It's just,
Going back to macro again, we were talking before about inflation. We were talking about the Fed as well too. What is your major economic fear?
Oh boy, I mean, I fear monetary collapse, to be honest with you. I think mathematically it's kind of baked in the cake, and it's going to be wrapped up in the politics. And we're obviously in a very nasty fourth turning, and to me it's clear to me that, and I'm shocked that Howe didn't talk about it in his recent book, which I read, that it's all about the monetary issues, right? I mean, it's somewhat about geopolitical things in China and taking power in Russia, but it's really more about monetary issues. And so I think my greatest fear is that it happens quickly and chaotically, and that we have a Weimar-like experience. I hope that doesn't happen, but I think it's possible. Certainly in a 10-year time frame, I think it's possible. My hope is that what we're able to do is do some kind of a managed reset, and with a lot of government reform, which is badly, badly needed and overdue. That's my hope, because I think that harms the least. I mean, it gives the most people a chance to adjust without being harmed. But sadly, I fear that it could be more chaotic than that.
What news then are you following carefully right now?
I tend to, well, first of all, I don't watch CNN. I don't watch politics. I have libertarian views, but that makes pretty much everybody who's in politics today unattractive to me. I tend to watch the economic data pretty carefully, all around, but even that's cooked, so it's kind of hard, right? I mean, the inflation numbers are cooked, the unemployment numbers are cooked. I'll tell you, if you want to ask me what I wake up at 5 or 6 in the morning, what do I look at first? I look at the price of gold, I look at the price of Bitcoin, I look at the price of silver, and I look at the Dow futures. And because I think the markets are telling us kind of what's going on. And then I look at the long bond, and
I guess less the news. I guess what I mean, not news organizations rather, but what is the news event or that's most consequential in terms
Yes,
of...
okay, I see what you're saying. So to me, I think what's going on and what's really right front and center for me is what Luke Groman calls fiscal dominance, and what I believe the position we're in, which I think is going to force the Fed being trapped and being forced into yield curve control as a result of the federal deficit. So I think the federal deficit is a ticking time bomb. We're going to run a $2 trillion deficit this year, probably $3 next year. We've all seen the curve of the federal interest expenses. I mean, it's literally gone parabolic. I mean, the U.S. government, the U.S. Treasury is paying close to $1 trillion a year in interest expense on its debt, because it's got a lot of short-term debt, and short-term rates went from 0 to 5.25. So to me, that is just it's a hidden in plain sight disaster waiting to happen. And so I watch everything related to that, and there are little clues you get around, the Japanese 10-year yield, or the Japanese yen US cross, because the Japanese currency is fading. I mean, there are a lot of little clues you can see that all feed into that, or the US bond market and what's going on there, the price of oil, what's going on there. So I just look at kind of what the markets are telling me, and what they're telling me is that we're in the middle of a sovereign debt crisis, and absent. So some people come to invest in my fund, and they say to me, "Larry, what can go wrong? Why shouldn't I invest in this?" This is a smart question. I respect people who ask this, and I'll tell you what could go wrong. this, and I'm a sound money person. I've invested since '08. I've been 100% focused, dialed in on sound money. And I tell you what could go wrong. If the U.S. government suddenly got responsible, okay, and decided they were going to means test Social Security and Medicare, and maybe cut back the level for everyone else by 30 or 40%, and they decided they were going to stop sending money to Ukraine, and they decided they were going to cut the defense budget and pull back from all these bases that we have all around the world, and they were going to actually balance the budget. If they decided to do that, the sound money thesis would take a serious hit. Okay, and my fund wouldn't do well, and gold wouldn't do well, and Bitcoin wouldn't do well, and things that I believe in wouldn't do well. Having said that, I think if they do all of that, they would have an enormous economic downturn. So even, they would have a depression, and even then, it's arguable that, the sound money thesis would work, because if you think about what happened to gold in the Depression, it was fixed in its price because the government controlled it, but the price of everything else went down 90%. So in effect, its purchasing power went up 10x. So, we're really in one of those, we're in a tricky macroeconomic environment that is mathematically requiring us to have a reset, a monetary reset. And so the question becomes, how are we going to do that? Are we going to do it intelligently? Is it going to be forced upon us? How enlightened are our government leaders going to be? I'm not very hopeful, right? It's a mess. It's very sad, and it's a mess. But I'm in this trade more for my kids and their kids not yet born than I am for myself. And I'm in it also. I do these interviews. I'm a loudmouth on Twitter. I throw stones at the Federal Reserve because I think they're a bunch of evil people. And I do it because I really believe that we went badly off track by following the Keynesian model. That we should have stayed. Breaking the gold standard in 1971 was an enormous crime, an enormous mistake, and has really, in many, many ways, ruined the world. I really sincerely believe that. And I know that's, to the average normie, that's a crazy and outside the boundaries view. But to anyone who's actually looked at it and studied it and understood what it was before then, it's pretty clear to me. And, and I think that mathematically, it's going to become pretty clear to everybody else too, when inflation here is raging, and maybe bordering on kind of Argentina sort of stuff. What are we going to do? How are we going to solve it? It's not clear to me that the existing politicians can do that. And so, we're going to need a whole new crew of different politicians, who have a better view and understanding of what's going on, and that will happen. These old guys and women are going to time out, as they should, and we'll get. I look at my kids' generation. My kids are all millennials; they're all in their 20s, and and they say, "Dad, I'm screwed." And I say, I can't argue with you. On my salary, I can't afford to buy a house. I say, I know, I get it, and that's why we're fighting this fight. That's why being an investor in sound money is not, it's about a lot of things. It's about protecting your assets and protecting what you've worked all your life for. But it's also about trying, in my view, it's a vote with your own money and your own conscience as to how you think the world should work. You can go to work for the government, you can believe in all the Keynesian stuff, you can believe in handouts. I don't think that's right. I think that the much better way is to have a sound money system and personal responsibility. So,
thank you very much, Lawrence. How can people find your views on X?
Yeah, so I'm on X just as under my name, Lawrence Lepard, so it's easy to find. And then I also have a website. It has a lot of information on it. It's all free. I have an email list, again, all free. We won't spam you. And that's EMA2, which is Edward Mark Alpha. I'm Equity Management Associates, the name of the company. So we abbreviated EMA, and then we couldn't get EMA, so we got EMA, and we put the number 2 after it, so .com. So you can go there and find something. And I will say, if you don't mind, I will say I do have a fund. The federal rules require that I have a minimum of $200,000, but we do accept new investors into the fund. And actually, I think the timing on it is pretty good, because I sincerely believe that in the next 12 to 18 months, we're going to see another leg up in this bull market, and things are very, very cheap right now. Our friends in the gold market will hope for such a rise as well. Oh, it's coming. Don't worry about it. It's coming. Lawrence, thanks for your time. Oh, thank you very much. Really nice talking to you. My name is Michael McRae for Kitco Mining here at the Precious Metal Summit in Beaver Creek, Colorado.
Kitco Mining's special coverage of the Precious Metal Summit is brought to you by Nucor Gold.